Recently, there has been a surge in interest in investing and trading stocks and shares, including for those who have not invested before. For example, some novice traders have started trading complex derivatives, such as options. You might be thinking, wouldn't it be great to pick one of those stocks that nobody else has found and goes up massively in value, making you rich beyond your wildest dreams? But how likely is this to happen? In this video, we demonstrate, using research and data, why stock picking is statistically a bad strategy for most people. This is not investment advice. If you need advice tailored to your specific circumstances, you should seek independent financial advice. Platforms such as Robinhood and Revolut Trading have made investments and trading easily accessible to all, which is a good thing. However, before you select an individual stock, one question you should be asking yourself is whether you have any information available to you that is not available to others in the market. So basically, do I know anything others don't? If not, is the stock market not working well in a way that I can use to my advantage? i.e., is there a market inefficiency such as a bubble or a depression? The efficient market hypothesis was originally formulated by Eugene Fama, a Nobel Prize-winning professor of economics. Fama's research shows that, at any given point in time, a stock's current price is a reflection of the potential future earnings that can be made from holding that stock. In other words, all available information is already priced in. Many factors affect this, including company-specific information, so trading statements, results, etc., or market-specific information. This could be geopolitical events, economic conditions, etc., etc. Although markets are not expected to be perfectly efficient, meaning there are going to be points of exuberance, so massive highs, and depression, massive lows, the question is, will you be able to find when exactly those events are and spot an opportunity before the market realizes it and prices the stock accordingly? To answer this question, we look at the data from the mutual fund industry. So how do the professionals get on? Mutual fund managers are highly paid, intelligent individuals with tons of expertise and experience, trying to beat the market on a daily basis. That too using the best tools and research available in the market. So you would think they'd be able to beat the market time and time again, right? According to S&P's SPIVA report, which is a comparison of how mutual funds perform when measured against their respective indices as a whole, 80% of all active funds worldwide fail to even beat market returns. In the US, over the past 5 years, 78% of large-cap funds underperformed the S&P 500 index. If you think this is bad, in Canada, 96% of mutual funds over the past 5 years have underperformed the S&P TSX Composite, which is Canada's benchmark stock index. And if you think professionals will be better at investing in emerging markets, you're wrong there too. 82% of large-cap funds underperformed the S&P BSE 100, which is the index of the 100 largest companies in India. If you think you might find some opportunities with penny stocks, so stocks in small companies, there are small funds that focus on small and micro stocks. The data shows these actively managed funds fail to meet the returns of their corresponding indices, such as the MSCI World Small Cap Index, as well. You might ask yourself, would an individual investor do better? The answer is no. Sadly, the data suggests that the vast majority of investors who pick stocks themselves either lose money or make less gains than average market returns. So what's the alternative? To not invest at all? That's not what we're suggesting here. You could invest in a low-cost, well-diversified passive fund. That's a fund that doesn't pick any stocks, but buys all the stocks in a given index, which will give you market returns. For example, if you had invested in a well-diversified worldwide index, such as the MSCI World Index, you would have doubled your investment in the last 10 years. There are some important data points to be aware of here, which we'll be covering in a separate video shortly, so don't forget to subscribe. Back to our main point. An important thing to note here is that passive funds usually have very low fees compared to active funds. This compounds over time, meaning that the money you're saving on high fund fees is being reinvested into your index holdings, which compound over time and increase your gains. So what does that say about stock picking? If the experts with billions of dollars under management with the best tools and data available can't beat the market, then an ordinary investor's odds are pretty slim. So what this means is, unless you have insider information, which is illegal, or have come up with a market-beating strategy, which other active fund and hedge fund managers have not seen, by picking stocks and hoping they will grow, you are basically gambling with your money. If, however, you think that you have an exceptional talent in identifying that great stock before the market can, and you believe you are the next Warren Buffett or Ray Dalio, then go for it, and best of luck. If not, then you shouldn't be picking stocks. If you want stock market returns, then invest in a low-cost, well-diversified index fund and get the market return. This may sound terribly boring and nothing like the Wolf of Wall Street shenanigans, but the data shows that it works, and that's all you really want at the end of the day. Even the great Oracle of Omaha, Warren Buffett himself, said it in his 2016 annual shareholder letter. My regular recommendation has been a low-cost S&P 500 index fund. Hope you enjoyed this video, and thanks for listening. Please subscribe and share with anyone that you think might find